Good evening, everyone. I wanted to understand about your fee income part, whereby it is increased on year-on-year basis to 76 billion. But if you compare on QOQ, there is a decline. In fact, after September, it has remained over and above of 81 billion. So I just wanted to understand, is it only seasonality or something else?
Yes. Thank you for asking. Yes. The fee income has got a seasonality. The Q4 is typically quite strong in seasonality, particularly from a third-party distribution fees. Normally, the season for insurance is quite high in the country around the January to March time period, and then it starts to pick up after the first quarter. So first quarter is low, and this year first quarter has been similarly in line with the past trends low. Yeah, there is seasonality to that.
All right. Also, you mentioned about cost of funds. Your yield on assets have also come down. I just wanted to understand that this cost of funds is something which has come down after a long time. Overall, how do you see them throughout the year, if you can give some kind of guidance?
Okay. See, the cost of funds has come down about by 10 basis points or so in this quarter. The yield on loans has come down, call it about 22 basis points this quarter. You know that there are market benchmark loans which are there, which is the floating rate loans. And these floating rate loans reprice faster than the cost of funds pricing. And so that is why you are seeing that there is a lead effect coming from yield going down. So it has to stabilize. So from here where it goes, it has to stabilize. The rate has to stabilize. You saw one more rate reduction of 50 basis points from RBI in June. And so that has to factor in fully yet. It is not fully factored in yet in the asset yields. So over the next quarter, it will factor in. And the cost of funds is a managed cost of funds, as you know that our bank and other banks determine and offer savings rate and time deposit rate appropriately. We competitively price these deposits, and the market is not fully priced in the reduction of the policy rates, which is 100 basis points down from February to June. The cost of funds or the deposit rates are not factored in yet fully the 100 basis points. And once that comes in, then you'll have to wait and see based on the renewal tenors and the new bookings that happen comes in at the lower rate. So there is a path for it, and the path will be a few quarters out.
Just one last question on corporate and other advances. Corporate and wholesale. That book is showing a muted growth. I want to get a guidance on that front. How is the on-ground situation looking like?
Yes, which is very similar to what we talked last time, which is the larger corporates are quite liquid, highly rated, and pretty strong on their balance sheet, which means the yield that one could get from that is lower. And we have seen competition from certain segments of the financial system where the rates are pretty low. They offer very low rates. And so consequently, while we like the quality, we have been selective in offering and waiting for the rates, that is at least the rates that the banks are offering to larger corporates to be stable. And even in this quarter, we have seen while the credit spreads widened by anywhere between 10 to 15 basis points, depending on a AA or a AAA, the loan yields continue to come down. So it's something that we manage on a close relationship basis with corporates to participate not just on a lending as a value proposition, but overall relationships which is non-fund based as well as the employee and the SME segment, distribution and supply chain segment. So for holistic relationships is where we participate in those kind of funding.